Hello and welcome to the Clear View. I'm Nick Bautista. This week we're talking about the Democrats' updated tax plan and how it will impact your personal finances. Stay tuned. So we keep getting more and more information every day of this week as Biden tries to close out his Build Back Better plan and what that looks like since they've trimmed back a lot of the spending that was originally included in this bill that I actually talked about a couple weeks ago, right before they extended the debt ceiling into December. They're still working to get a deal done, and it looks like we got some more framework from what might be an updated deal. So I want to take you through the impact, at least how we see it, to your finances, right? I'm not going to talk about any of the political side of things. I'm going to get more into how are things going to be paid for and how that may affect certain clients around this bill. So what I have pulled up here is the White House briefing on what Joe Biden came out this morning and said how the plan is going to be paid for, right? All the spending and all the goals that they had to implement for that spending, and it's got to be paid for in some way, right? And this is the framework for how they expect to do that. So you see the first bullet point here goes on to describe creating a minimum floor of corporate tax. So different corporations can have different tax rates, progressive tax rates, just like our tax system, right? It moves all the way up to, I believe it's at 21% right now, being the top rate for corporations, C corporations, right? So take out of the mix you self-employed business owners, right, who are doing S corps or LLCs or just filing as sole proprietors, right? It's strictly focusing on big companies, the Apples, Amazon, Googles of the world, right? So part of the framework is they want to be able to impose some kind of minimum so that a lot of these companies can't essentially skirt away from paying some version of 15% taxes on their profits. And they've also imposed, or talking about imposing, putting a 1% surcharge on stock buybacks. The other point that they want to really topple is, using some kind of, again, minimum 15% to impose outside of the U.S., right? So it comes down to shipping, it comes down to doing business outside of the U.S. and having some agreement with outside countries that they'll have some kind of taxation for U.S. corporations that derive a lot of their income from outside the U.S. So here we have the next bullet point, which talks about adding an additional tax on top of where we sit today, somewhere around the 37% tax bracket, right? They're talking about adding an additional 5% to essentially households that have income above $10 million. They've also talked about adding some kind of, they call it 3% surtax on income above $25 million. So they're really trying to target the wealthier individuals, which are the business, the Jeff Bezos of the world in this case. They also bring up in this last sentence here the idea of closing what they consider a loophole, which I think they're trying to say means the idea of allowing an individual to leave taxable account to their beneficiaries, right? So the example of if you bought a stock at $100,000, it's in a brokerage account, it's in a trust account, that account grows to $1 million. If you were to pass away and leave that money to your beneficiary, to your kids, they would, as it stands today, they would get what's called a step up in basis. So they would get the stock, they would inherit the stock at $1 million the day basically you passed away. That's the value that they get inherited. So they get what's called a step up. So they don't inherit the stock at the same price that you bought it at $100,000. They inherit it at $1 million. So they've essentially bypassed $900,000 worth of capital gain by inheriting the stock, and they can turn around and sell it, and there'd be no capital gains tax to them, right? So I believe that's kind of what they're trying to point out here. At least that's what it sounds like to me. that they're trying to close that loophole. And they've said it before in the past, and I brought it up about trying to do something around inheritance and eliminating some of that step up piece because they feel that it unfavorably is for the wealthier individuals. And then the last one is to really get more resources around the IRS for the agents to go out and audit more of the smaller corporations, more of the partnerships, so that they can start claiming and getting more of those tax dollars back. So what does this all mean? Right? They've gone through a couple different bullet points of how they really want to add some taxes to some high net worth individuals. And so for most of us and for most of our clients, you guys, we don't see this being a huge drag on your personal income side, right? We don't see this affecting your personal income taxes when you go to file at the end of the year or even in the coming years, because what this plan is really aiming to do is to go after a lot of the corporations. It's not really meant to focus on individuals other than that provision in there around taxing maybe inheritance or taxing certain partnerships that are doing some things that they maybe shouldn't be doing when it comes to filing their return. So in terms of personal and how this may affect your personal finances and taxes, it doesn't look like there's going to be a huge impact. What might be more of an impact is the impact on corporations, right? Having to report or pay more on the taxes that they haven't necessarily paid in the past, which just becomes an added expense to those corporations. So maybe their earnings, maybe their profits start to come down a little bit because it's getting eaten up by a little bit more of that tax. But overall, we don't see that being a material thing that would drive companies to do worse, would drive them to be overvalued, right? It's just a little small step for them to essentially make up and not have as much to profit or essentially retain a lot of those earnings that those companies have earned to either pay out dividends, reinvest in the company, which you could argue may slow down the company, may slow down future projects because they got more tax that they have to pay now. However that might shake out, we still don't feel like it's going to be a huge material impact because a lot of these corporations are already paying a decent amount of taxes that appears to be beyond 15%. So overall, it looks like, at least in this plan, depending on where you sit on the tax tables, it's not necessarily going to affect you as much. Right. Again, I'm not focusing on any of the policy and what, some of the stuff means politically, but in terms of purely the financial picture, it doesn't appear to be really infringing on where we sit today for our personal finances. So if you like this video, give it a like, subscribe, share with your friends. We're trying to really grow our channel so that it's helpful information. If there's something you want us to talk about, please let us know. Have a great day.